Welcome back to the deep dive. Today, we're looking at a market that is really being pulled in two directions. You've got this incredible force of AI growth on one side.
But then this immovable object on the other, tight liquidity, central bank worries, and, well, what just happened? A pretty painful leverage flush.
Exactly. So our mission today, as of December 2nd, 2025, is to cut through that noise, figure out what's driving this huge risk repricing, and find the signals that you really need to be watching.
It's a critical mission because the tension is palpable. We have to start with the macro picture. Rates and liquidity.
And the story there is scarcity.
It is. Delayed rate cut expectations are just dominating everything. Capital is expensive, and that ripples out everywhere.
So give us the hard numbers. What's defining this environment right now?
Okay, U.S. Treasuries. They're setting the global price of money. The 10-year yield is around 4.08%.
A 2-week high.
Yep. And the 2 years holding at about 3.54%.
And the relationship between them, the curve, is still positive, about plus 0.54%.
Which matters. It means the market is still demanding a premium for long-term risk. It shows there's just no confidence the Fed is going to aggressively ease up anytime soon.
Okay, so tight money here at home. And that sentiment immediately went global, didn't it?
Absolutely. Global risk preference is weak. A big trigger came from Japan, actually.
The Bank of Japan?
Yeah, the recent talk was seen as pretty hawkish. And even a hint of rising bond yields there caused global risk managers to, well, hit the panic button.
A recipe for fear. How do we measure that?
The VIX, the market's fear gauge, is sitting in the 17 to 18 range. It's not panic, but it's definitely an alert state.
And in the more speculative corner?
Oh, it's way more pronounced. The crypto fear and greed index is just stuck on fear. It's showing extreme caution amplified by all this leverage we've been talking about.
Let's connect that fear to actual assets. What about mainstream equities?
We saw a modest pullback. The big ETFs, like VOO for the S&P 500 and QQQM for the NASDAQ, they dropped maybe 0.2% to 0.5%. Not a crash, but a clear sign the tide is stalled.
But the underlying AI story, with giants like NVIDIA and Google, seems almost bulletproof.
And that's the core conflict. Strong fundamentals are great for the long term, but they don't make you immune to short-term market noise.
So you look at the high beta names.
Exactly. A name like Tesla is just whipping around in that $420 to $430 range.
Yeah.
These are the stocks that are the canary in the coal mine for risk aversion.
And if Tesla is the canary, crypto is the entire highly leveraged flock. This leverage flush was the main event.
It really was. For anyone who doesn't track this daily, a leverage flush is just a cascade. The price drops a bit, which forces automatic selling of leveraged positions.
Which pushes the price down further, forcing more selling.
A self-reinforcing downward spiral. And this one was brutal. It centered right on Bitcoin in that $86,000 to $90,000 range.
Ethereum got hit too.
Yep. Big liquidations around $2,700 to $2,800. We also saw Solana get hammered in the $120 to $135 range. It just shows the vulnerability when the macro tide turns.
And this is where it gets really interesting. Bloomberg Intelligence put out a warning that connects this crypto volatility right back to a classic defensive asset.
Gold. This is such a critical piece of analysis. They're looking at the Bitcoin to gold ratio.
So how many ounces of gold to buy one Bitcoin?
Correct. And it's currently near 20x, which is an historical extreme. Analysts are warning this ratio could pull back to around 13x.
And if that happens, what does it mean for Bitcoin's price?
It implies really significant downside. If you just run the numbers, a return to a 13x ratio could put Bitcoin's price potentially down near $50,000.
Wow, that is a classic flight to quality signal. Shedding the aggressive asset for the defensive one.
So when you put it all together, the market is in what I call a risk repricing plus liquidity sensitive phase. Defenses have to be your priority.
Okay, so let's talk strategy. What does reducing high leverage exposure actually look like right now?
It means avoiding complexity. It means shedding exposure to things that are illiquid. We're talking about, crypto pre-stocks, these venture-backed tokens that are hard to sell and to squeeze. You need cash ready.
And where should people seek that refuge?
Well, cash is king, obviously, or cash equivalents. Gold has been strong all year. And if yields keep rising, short-term U.S. debt, like T-bills, offers a great defense.
What about those who still want to be in the main crypto assets like Bitcoin and Ethereum?
The approach has to be surgical. Low leverage or, frankly, no leverage positions. You should wait for the smoke to clear from these liquidations. And you must use strict stop losses. This is not the market to just passively hold.
So the game is to preserve capital and wait for the real catalyst.
That's right. And that catalyst is the U.S. core PCE data.
The Fed's favorite inflation number.
It's their favorite because it's a better measure of actual household spending. If that number comes in soft, if it shows inflation is really easing, liquidity expectations could flip positive almost overnight.
And that would be the signal for risk assets to run again.
That's the signal.
So we'll leave you with this final thought. While the immediate action demands caution and defense, the medium-term game is all about waiting for that inflation signal. Until then, take a hard look at your own portfolio and ask yourself this. How much of it is truly protected from this kind of volatility, the kind driven by leverage and shifting central bank talk? If the answer is not enough, well, now you have a plan.